Specifically, we're trying to ask the question, do these machines have a price, a correct price? And if so, what is that price? For example, you can see on the screen the Bitmain Antminer S19, which is a relatively new Bitcoin miner, and it's on sale as of a few days ago. It costs $10,000 instead of $15,000. And people are willing to pay this price. We can see that it's out of stock literally everywhere. And we're trying to figure out, are miners correct in the willingness to pay for this machine? Maybe this is indeed a bargain. Maybe they're overpaying. So we'll figure this out at this talk. I assume that everyone here knows what cryptocurrency mining is, but if you don't, in a nutshell, it's the process of creating blocks in order to authorize transactions and secure the system. In proof-of-work mining, at least, this is a computationally intensive process that requires a lot of electricity, and thus miners are compensated with some bitcoins per each block that they mine. In Bitcoin, mining hardware usually uses a specific type of hardware called an ASIC. It's just really good at performing the computations needed for Bitcoin in a power-efficient manner. And the performance of mining machines is usually measured in hashes per second. So we are not the first people who have tried to figure out how much mining rigs should cost. People have tried to do it before us, and thus many mining calculators have sprung up all over the internet. For example, you can see one here, a mining calculator for the Antminer S19. But these mining calculators are quite naive. They assume that everything is constant, including Bitcoin's extremely volatile exchange rate. As we saw just a few weeks ago, it can go up quite rapidly and then immediately crash. And this is actually a very decisive factor in the correct cost for an ASIC. Miners, as we all know, will not operate their machines just to make a loss. They operate their machines only if they're expected to make a profit. So the exchange rate is a decisive factor in that, because whenever the exchange rate is too low, their expenses will exceed their profits, and thus they'll turn off their machines, as we saw many times in the past. For example, in this graph, you can see Bitcoin's hash rate history. And indeed, whenever the price collapsed, so did the hash rate. So did all the available computing power on the network. In order to capture this decision to mine, including all the factors that affect it, we've written the miner's utility using this formula, which is quite standard. It appears in many other papers. On the left side, you can see the reward. We assume that all miners are part of a mining pool, and thus their fraction of the reward is equal to their fraction of the total computed power that they contribute. And on the right is the expense. The expenses are mainly the electricity that the miner requires, but electricity is usually paid for in dollars, and the reward is usually in Bitcoin. So we have to adjust the units, so we multiply the reward by the exchange rate. And as we saw, miners can turn off their machines, and the reward for turning off a machine is zero. They don't pay any money for electricity, and they don't make any profit. So the utility, the total utility, is a maximum between the reward made for mining and the reward made for not mining. If that equation seems familiar to you, it's because it's quite similar to the equation of an options value, and this actually leads to a major insight that underpins our work, that mining a single block is actually equivalent to a single European call option. And if you don't know what it is, a European call option is a contract between two parties, a buyer and a seller. It allows the buyer to buy some asset, for example, a stock, at some future exercise date for a predetermined amount of money called the strike price, and the buyer may choose not to buy the asset. So, for example, I may have an option on a single Tesla stock, and if the exercise date is tomorrow and the strike price is $2, then if by tomorrow Tesla's stock will be worth $3, then it will be wise of me to buy the stock using my option, because I'll buy it at a cheaper rate than the actual rate on the free market. On the other hand, if Tesla's stock price will by tomorrow fall to $1, then I'd rather just buy it on the free market instead of using my option. So similarly, While mining a single block does not require signing a contract usually, it requires a physical machine. It's practically the same in every other way. It allows you to obtain a certain asset, specifically bitcoins, and the exercise date comes every 10 minutes, every block mining period, and the strike price is the price required for the electricity that the machine requires for mining a single block. And as before, the miner may choose not to use his option. He can simply turn off his machine, not pay any expenses, but also not get any reward. So if mining a single block is equivalent to a single option, then an ASIC is equivalent to all the options that it offers over its lifetime. It's a bundle of options. So the price that people should pay for this ASIC should be equivalent to the sum of the prices of all the options that it offers. Luckily for us, option theory is quite well developed. For example, the Black-Scholes method for pricing options. We use a similar discrete analog for it to price mining options. These methods, both Black-Scholes and the method that we use, assume that markets are efficient, meaning that no arbitrage is possible. Arbitrage is the possibility of making a riskless profit. In our paper, we show that any price that is not equal to the price that we give using option theory is incorrect. Why is it incorrect? Because it allows making a riskless profit, which is in contradiction to our assumption. And we obtain the correct price by creating a portfolio of tokens, for example, Bitcoin, the tokens that are to be mined, and government bonds, such that this portfolio produces the same exact returns as the ASIC we're trying to price. It's easy to compute the price of the portfolio because we know how much Bitcoin is worth, we know how much the government bonds are worth, so we can do that. And after a lengthy proof, we deduce that the ASIC's price must be equal to the price of the portfolio, otherwise arbitrage is possible, again, in contradiction to our assumption. We've provided an algorithm and some formulas that compute this value. And now we'll run through a nice example. Let's try to price a very simple ASIC, an ASIC that can mine just a single block and then it dies. This block is to be mined tomorrow. The reward for turning on the ASIC is 1 Bitcoin. We get it for sure if we turn it on, but we'll have to pay $250 for electricity. Let's assume that Bitcoin's price today is $400, that it can double to $800 with a probability of 50% by tomorrow, and it can halve with a complementary probability to $200. And let's, for simplicity's sake, assume that the interest rate is 0. It doesn't really matter why, but it's an important factor in pricing options. So let's ask the seemingly simple question. How much is this ASIC worth today? Again, it can only mine a single block. So if we'd use a naive mining calculator, we can just ignore the random walk that Bitcoin's exchange rate is walking, simply use Bitcoin's value today. So if we turn on the machine, we get 1 Bitcoin, which is worth $400 today, minus expenses, which are $250, we get $150. That's the naive calculation. And let me tell you that this price creates an arbitrage opportunity. In the paper, we provide a full step-by-step proof that indeed you can make arbitrage if this is the price of the ASIC. Let's try to do something smarter. Let's take the expectation of the profit. The expectation is supposed to take the random walk into account. So Bitcoin's value tomorrow will be $800 if it indeed goes up. And then if we'll turn on our ASIC, we'll receive that 1 Bitcoin, which is worth $800. And after paying for expenses, we'll receive a net profit of $550. If Bitcoin's price will go down, our profit will only be $200. And that's less than our expenses, so we won't turn on our ASIC. So our profit in that case is $0. If we take the expectation, we get that the price should be $275. And again, this price creates arbitrage as shown in our paper. The actual correct price is $183, and again, This is quite a lengthy process, but we show it step by step in the paper. If you're interested, read it. So we've tried using our algorithm and equations to correctly price the Antminer S9 over the years. It's been available on the market for quite a while, so we have a lengthy price history for it. This graph depicts both the official Amazon price given by Bitmain, the manufacturer, over time, and also the price obtained by using the expectation method, the one that I've shown just a few slides ago. And in green, you can see the prices obtained by our method. So indeed, as the title hints to, our prices are lower than the official Amazon prices. A very cool implication of our work is that Bitcoin's exchange rate volatility, meaning the square root of its variance, is actually a very good factor for the correct price of an ASIC. Most people assume that volatility should scare off miners and thus should also decrease the value, the correct price of an ASIC, but the opposite is true. If volatility could increase even more than it is today, which is quite a lot right now either way, the correct price for an ASIC could increase by up to 70%. And that is because losses that can be made with an ASIC are bounded by zero. If you don't want to make a loss, just turn it off. But profits are potentially unbounded because if Bitcoin's exchange rate is volatile, it can go up and up and up and up, and thus people can make potentially unbounded profits. Another implication is that waiting for an ASIC, which is actually quite commonplace, is very bad for the correct price of an ASIC. For example, if I were to order an ASIC on April 2019 and I'd have to wait 100 days until receiving it, then the correct price would halve, according to our method. And this is explained by the hash rate growth on the network. It grows almost exponentially. Well, it does grow exponentially, which means that if we wait, we will face way more competition than we would if we'd receive it immediately. Another very cool implication of our work is that it is possible to imitate mining hardware, as I've explained before. And in this graph, you can again see the Amazon price given by the ASIC's manufacturer. And you can also see the price of the imitating portfolio. Again, I remind you, this portfolio is comprised of the tokens that the ASIC can mine, for example, Bitcoin and government bonds. And as is apparent, the portfolio's price is almost always lower than that of the ASIC. Above these prices, we can see the profits. Right now, in blue, we see the profit that can be made by using the ASIC after all expenses, after paying for electricity. And in orange, you can see the profits made by the portfolio after paying for all expenses, which are mainly the transaction fees that you need to pay for transacting, buying and selling tokens and government bonds. So the portfolio produces a higher profit even though it costs less. An interesting question that this arises is proof-of-work mining inherently flawed? First of all, why would anyone mine if they can simply imitate mining hardware? Imitation is easy. It just requires trading. Everyone knows, well, not everyone, but more people know how to trade than they know how to mine. So it seems like we're kind of losing on mining incentives here. A common thought is that one day Bitcoin will become mainstream and then its volatility will cool off. According to our paper, that means that it would be easier to imitate because the lower the volatility, the less transaction fees people have to pay in order to imitate an ASIC. And again, it seems like we're losing out on mining incentives. So that about sums it up. We're currently working on a technique that might mitigate the potential of imitation to scare off miners. We're trying to artificially inject volatility into the mining process by giving out random block rewards. These block rewards are random, and thus they increase the volatility. And hopefully they can increase it enough so that the transaction fees required for imitation would be so high that imitation would be unprofitable. Additionally, we're trying to expand our model to include mining machines that have multiple low-power modes. For example, modes that require less power and are more power efficient, but so modes that require less power but are also less powerful. We know that people, whenever Bitcoin's price drops, underclock their machines because activating them at full throttle would just incur a loss, so they underclock it in order to make it more power efficient, and then they can just leave it on. Additionally, we want to endogenize the hash rate growth. We know that whenever Bitcoin's price is high, people buy more hardware, and when it grows over time steadily, people buy even more hardware, and the converse is also true. Currently, our model doesn't take this into account. And that's it. Thanks. No? Really? Is it new? Well, first of all, he asked if I know which coin does a random block reward, and Dogecoin is the answer. Is it new?
No, but originally no one thought it was useful. My question is whether this applies to proof of stake or might apply to proof of stake in some
Proof of stake is kind of harder to think of in these terms because you don't throw money out and get something in return. You lock money. What you lose is the liquidity, and that is something that we indeed are thinking of.
Using black skulls, how do you factor in for different people who don't have access to government bonds?
That don't have access?
Yeah, like a Chinese miner can't buy American bonds, and also different electricity costs.
Yeah, so he asks, how do we take into account that some people don't have access to government bonds? For example, maybe Chinese buyers don't have access to US government bonds, and also he asked if we take into account electricity costs. Regarding electricity, yes, we do take it into account. You can just input the price that you'd pay for electricity, and you get the price that is correct for you. Regarding government bonds is just a general term to mean a riskless asset, or an asset that gives you the risk-free rate in the economy, which is the interest rate. So you can buy Chinese bonds if you'd want. Okay. Do I have time for all that?
I think one more question.
Ita.
Can your model include the maturity period of new minted bitcoins?
The 100 block period.
Yeah, exactly.
So Itai asked if my model takes into account the maturity period. Miners, when they receive a block reward, they can't use it immediately. They can use it only after 100 blocks. And no, the model currently assumes that this is not the case because otherwise it won't really be an option, right? Because then you might mine, and when you get the reward, you'll find out that you actually lost. Thank you, everyone.